Ever heard of penny stocks? Those super cheap shares that promise massive returns overnight. A lot of people, especially those watching American finance content, think these exist everywhere. But what if I told you that in the Gulf countries, Saudi Arabia, the UAE, and Qatar, penny stocks, as we know them, are a complete myth? That's right, they don't officially exist, and this fact surprises so many investors in the US. The term penny stock usually means shares with a very low price, often tied to weak regulation and a whole lot of speculation. It's natural to assume this model applies worldwide, but that's a big mistake when it comes to the Gulf markets. These markets operate under a completely different philosophy, with strict regulations and a unique approach to managing investment risk. Let's break it down. In Saudi Arabia, you have the Tadawul. In the UAE, there's the Dubai Financial Market, or DFM, and the Abu Dhabi Exchange, ADX. Over in Qatar, it's the Qatar Stock Exchange. All of these markets have one thing in common: very tough rules for companies that want to be listed. They must meet high standards, provide regularly audited financial statements, and stick to strict corporate governance codes. Because of this robust structure, there's simply no official category called a penny stock. Regulators in the Gulf just don't label stocks that way. So, if there are no penny stocks, does that mean there's no risk? Of course not. But the risk comes from a different place in the Gulf markets. The main risk factors are small cap size and low liquidity. Small cap just means the company has a smaller total market value compared to giants like Aramco or Sabic. Low liquidity means the stock isn't traded very often, so it can be hard to buy or sell large amounts without affecting the price. These two factors can cause sudden, sharp price swings. This is crucial to understand. A stock can be risky even if its share price seems low and affordable. Risk here is measured by a company's fundamentals and its trading volume, not by its price tag alone. It is also really important to clear up a common misunderstanding. Small cap does not mean a company is bad, and it certainly doesn't mean it's harem. Many of these smaller companies in the Gulf are legitimate businesses with real assets and operations. They function in halal industries, generate real revenue from actual economic activity, and many of them even pay out regular dividends to their shareholders. A low share price doesn't automatically mean the company is a scam or unsuitable for Muslim investors. This single misconception leads so many people to make poor financial decisions, either by chasing what they think are bargains or by avoiding perfectly good companies. Now, let's look at this. From an Islamic personal finance perspective, Islam permits investing, but under specific conditions. The investment must be based on real, tangible value. It has to be transparent, and it must involve ethical activities. Islam doesn't prohibit taking risks. What it strictly prohibits is riba, which is interest, gharar, which is excessive uncertainty or deception, and maysir, which is gambling. When you start buying stocks blindly just because they have a low price, you're not investing anymore, you're speculating. And that speculation can very easily cross the line into maysir. True halal investing requires you to understand what you're buying, why you're buying it, and the real value behind your investment. Unfortunately, many investors in the Gulf fall into the same traps. The most common mistake is chasing low-priced stocks, thinking they've found a hidden gem that's about to explode. They completely ignore trading volume and liquidity, which, as we discussed, are the real indicators of risk. They get caught up in frequent trading, trying to make a quick profit instead of focusing on the long-term value and growth of the business. And perhaps the biggest mistake of all is confusing this kind of speculation with genuine halal investing. These mistakes can destroy your wealth, even in markets as well regulated as those in the Gulf. So how do you protect yourself? It's actually quite simple. You can use a basic halal checklist before you invest in any company. Just ask yourself 4 key questions. First, is the company's core business halal? For example, it shouldn't be involved in alcohol, gambling, or conventional banking. Second, does the company generate its income from real economic activity? You want to invest in a business that creates actual value, not just financial engineering. Third, Is the company's debt level within acceptable Sharia limits? Too much debt, especially interest-bearing debt, can make a stock non-compliant. And fourth, is the stock liquid enough? Can you easily buy and sell your shares without causing a major price drop or getting stuck with them if you can't get clear, confident answers to all four of these questions? It's probably best to stay away from that stock. The key takeaway from all this is pretty straightforward. The idea of penny stocks is largely a Western concept, born from a different regulatory environment in the Gulf. The focus is on a company's size, its fundamentals, and its liquidity, not on an arbitrary price label. A low price doesn't mean low quality, and a high price doesn't guarantee safety. Remember, Islamic investing is all about ethics, value, and responsibility. It's not about chasing cheap prices and gambling on the outcome. If you're interested in learning more about Islamic personal finance, explained in simple, easy-to-understand language, make sure you subscribe to our channel. We break down these complex topics to help you manage your money the halal way. Thanks for watching. In our next video, we'll take a look at the difference between two very popular investment vehicles, REITs and ETFs. You won't want to miss it. Don't forget to subscribe so you get notified. See you in the next one.